Hey, what's up, everybody? Welcome back to Investing Sucks. And today I'm going to be doing a video talking about a company that is a very under the radar type of company that caught my eye recently. And it's one that I've done a decent amount of research on and actually been pretty impressed with what I've seen thus far. And it's one of those companies where, upon first glance, it actually seemed like it was going to be a pass from me. But upon doing a further review and looking into it a bit more, it actually seemed quite compelling. So that's what I want to share with you in this video. So, the way I actually discovered this company was from a script that a user of the website Tickernomics here created. And what it does is you can access this if you go to user content here, and then it's this one here called Top 5 Highest Operating Margin by Industry. So these are all the industries, basically, of all the companies from the New York Stock Exchange and the NASDAQ. And it takes the top 5 highest operating margin companies from each one. So it's a simple but effective script. And the reason I really like it is because it allows you to identify companies that are exceedingly profitable for their industry. So companies that are doing something different, they have something unique about them. There's some unique advantage that they're doing that's leading to them to be more profitable. And I also included, or the user of the website also created other items here. So you can see there's the 5-year average. So you can tell if it's just one really strong year or if they're on average, they've been doing a similar level of a profit margin. You can see the stock price, the market cap, and then also some valuation metrics like price to earnings and price to sales. So say you're interested in software, you can type that in and you can see these two industries, application and infrastructure. So you can see Microsoft, that's a company we all know that's number 3 on this list. But there's actually companies with higher operating margins. You can see this one here, which actually, if we look at the valuation metrics, it even has a cheaper price to sales and a cheaper PE. Now, that's obviously there's probably a reason for that. Maybe their growth potential isn't quite as strong as Microsoft. They don't have as entrenched a moat as Microsoft does, but it's a starting point, and you can use this to find companies that maybe other people aren't really looking at. So the one that caught my eye is actually at the top of this list, and it was in the airlines industry here. And the company is this one, ATSG, which is Air Transport Services Group. And the reason it caught my eye is because airlines in general, the airline industry, I was pretty shocked to see a company that has a double-digit operating margin in the airline industry. And one that it's currently at about 14%, and the 5-year average is just under 12%. So it wasn't just a one-off year, especially considering what's happened with airlines over the past few years and what we've seen happen with travel. I was pretty shocked to actually see this. And when I looked at the valuation metrics, it seemed valued relatively cheaply, right? I mean, a 10 PE ratio, that's generally seen as cheap, but of course, it depends on what industry you're looking at. But also, the airlines industry is one that is notorious for being extremely brutal, right? Low profitability, high uncertainty, pretty much one of the worst industries that you can invest in because there's so many things that can go wrong. Like fuel costs could go up, the employees could go on strike, you got weather issues, you got all these types of things. But despite that, if we actually look at the stock price performance for ATSG here, they've done pretty well, just under 20% compounded return over the last just over 10 years here, which is quite strong, right? Not a lot of companies have done that. And if you're offered a 20% compounded return over 10 years, that's definitely an investment that I think most people would want to take. Now, before I go any further, I do want to kind of give a warning to say that this video is about to get pretty technical. It's probably going to be pretty boring because this is quite a boring company. It's not a cool tech company like Tesla or Palantir. But personally, I like boring. I like to think that one of my God-given superpowers is my ability to be fascinated by topics that the average person would find really boring, which hopefully gives me an advantage in the investing world. But I mean, that remains to be seen. But what I want to do is talk about, firstly, what makes this company actually unique, right? Why is this company, of all the airlines industry, why do they have the highest operating margin? And if we go to the description of the company here, it basically explains what they do. And they have two main things that they do. One is they lease aircrafts. So they purchase aircrafts, Airbus, Boeing 767s, the classic aircrafts. And then they also have air cargo. So they're part of the whole e-commerce value chain where they actually transport cargo in their airplanes. They call them freighters, which they actually have to pay money to convert a traditional aircraft into a freighter. They have to pay about $30 million to that. So they do have pretty high capital expenditures, which we'll talk about in a bit. But very little of what this company actually does is transporting passengers. It's mainly what I just said, which is the air leasing. So taking planes, leasing them to third parties, and then also the air cargo transportation. So I found that pretty interesting that the most profitable company in the airline industry doesn't even really deal with passengers. They do a little bit of their business is transporting passengers and collecting ticket revenue and that type of thing. But I mean, there's a few other airlines here, like we can see Delta Airlines, SkyWest, but the most profitable company in the airlines industry, not a lot of what they do, only a small percentage is actually dealing with passengers. So, like I said, after doing some research on the company, I could honestly probably make an hour-long video talking about all the nuances of this company, but I do want to keep things simple here and stick to a few key points. So I've got 4 key points here that I want to go over just to help you guys understand this company and maybe also give you some insight into my personal research process and what I'm kind of looking at, what I'm debating when I'm thinking about this company. Because like I said, this is a company that I am actually genuinely interested in opening a position in. So point number one here is they have an extremely top-heavy customer base. And when I say extremely, I mean extremely, extremely top-heavy, where their top three customers, which are the US Department of Defense, Amazon, and DHL, those account for the vast majority of their revenue. I mean, those three in total count for about 73% of their revenue in just three customers. So extremely, extremely top heavy. So this is a risk, but it's really only a risk if those customers actually end up leaving and going to use a different company, right? Which this company does have competitors. I would say they are unique in what they offer, but there are other companies that offer the same services as them. So it is a risk, like I said, but it's only a risk if these companies will actually leave them, right? If ATSG provides something that's so valuable that they can't leave them, then it's not really a risk, right? And one thing, I'm still kind of in the process of trying to figure out what really is the value they provide, if there actually is some genuine value that these customers are never going to leave ATSG. But one piece of evidence that I did find was how long that those three customers have been around. So the Department of Defense specifically has been a customer since the 1990s, so pretty much since the inception of the company. So I think it's safe to say that that customer will stay around for a while. And then DHL, which is a company, I believe they're a German company, but don't quote me on that. But they've been a customer since 2003. They use them for transporting cargo mainly, and they're currently leasing 12 of their Boeing 767s to them. So that's, I believe they had about 42 total aircrafts. But again, don't quote me on that. But 12 of them are leased to DHL. And they're leased in the form of long-term contracts, which provides the company stable recurring cash flow. They can plan their business more effectively because they know how much they're going to get paid and when they're going to get paid. So that's definitely a positive thing. And that's one thing I liked about this company is that it is more on the stable side because they have that recurring cash flow. And then Amazon is the other one. Now, this one is a big one. This is their biggest customer. 35% of their revenue goes towards Amazon. They became a customer in 2015 and they're currently leasing 42 Boeing 767s to them. So I guess they must have more than 47 total aircrafts leased or whatever number I said before, but these are the correct numbers here. 42 Boeing 767s. And what's also interesting to note is that Amazon owns 19.9% of ATSG, which they acquired through warrants. So if you don't know what warrants are, they're kind of similar to stock options. They basically, when Amazon came on as a customer, they also issued warrants to Amazon to acquire shares of their stock at a discounted price, so a price that's below the current market value. And from what I can tell, they do have the ability to acquire up to 39.9% of ATSG in total. Amazon does. So you can really look at that in two ways. You can look at one in the positive way, which is Amazon believes in the long-term potential of the company. So they want to own a piece of that potential. They want to own the company itself. That's the positive way to look at it. Or the negative way is Amazon doesn't really care about the long-term potential and they're really just doing this because they can, because they're such a powerful customer that in order for ATSG to convince Amazon to, lease their aircraft specifically and sign the contracts with them rather than other companies, or even use their own version of this, which I believe is called Prime Air, which is Amazon's own, logistics network that involves airplanes and shipping cargo around the world. maybe they're just doing this because they have the ability to. And whenever you can see a pattern when I was kind of reading about them, whenever ATSG would get new aircrafts and lease them to Amazon, Amazon would be issued warrants by ATSG, which no other customer had that. So clearly, Amazon is a very powerful customer, and it is a bit of an unfortunate scenario because you don't really want to be invested in a company that is probably going to get bullied by Amazon because historically that hasn't worked out well for a lot of companies. So that's really the one big negative thing that I've found out about this company so far. But the Amazon leases are long-term in nature. They have various ending terms. The terms end from 2023 out to about 2030, which is what I could tell from looking at them. And really the risk is that with these warrants, they do cause share dilution, which share dilution is a risk for any investment no matter what, because if the number of shares outstanding increases, then your percentage ownership in the company is going to go down. You own less of the company, you own less of the cash flows they produce. So even if they're producing an increased amount of cash flows, if you're getting diluted, then you don't really see that added benefit. And this here is a snippet that I took from the uh, from the most recent 10K. I don't know if you can really read this too well, but it says basically just says what I just said. If Amazon exercises its right to acquire shares of our common stock because of the warrants they have, it will dilute the ownership percentage of existing stockholders. So that's point number one. Very top heavy customer base, and Amazon is essentially bullying them. Now, point number two is their greatest competitor is fuel costs. Now, this isn't to say that they don't actually have a real competitor. They do, which is Atlas Worldwide Holdings, or AAWW, that's the ticker symbol. And interestingly, Amazon actually holds warrants against this company too. So they're not just bullying ATSG, they're also bullying this company. And I think Amazon needs that because they do have such an advanced logistics network that they need their own version of it, which is Prime Air, and they need other companies to, to lease aircrafts from. So maybe they're doing that because they don't want to deal as much with operating so many different aircrafts because that's probably carries a lot of cost with it. So it's better if they can outsource it to companies that have more expertise in that field, even if they're sacrificing some operating margin there because the companies that they're leasing from want to make a profit as well. That's probably what the benefit is, but that's just one insight on that. So, like I said, this isn't to say they don't have competition, but the fuel cost is really a big competition for them. So, number one, it's a big cost item. So this is their income statement here. It's not their biggest, but their biggest is going to be salary and wages because they do employ a lot of people. Their next biggest is depreciation and amortization because they own a lot of capital assets, but that's a non-cash expense. And other than that, fuel is their highest cost, which we know fuel costs have probably gone up in the past year because oil's gotten pretty expensive. Now, it has gone down a little bit recently. In fact, I just to keep people updated, here's the current price of oil. We can see this isn't the exact cost of aviation oil. Obviously, there's different types of oil, but it's all going to be tied in some way to crude oil. So it was currently at $100 a barrel. It's gone up a little bit recently. We can see it kind of hit $90 per barrel here, and it's at about 95 or $91 per barrel. But it was as high as in the 110s not too long ago. So oil prices have come down a little bit. Oil prices are not exactly predictable, though. I mean, you can go up 25 years and see it's pretty much all over the place. So, I'm not really saying I'm betting on oil prices going down. I think the company would still do decent regardless. But the reason it's a competitor or fuel costs would be the competitor is because when fuel costs increase, companies tend to stop using transportation services to transport cargo through the air and instead will use ground services because those tend to cost less. And that's really what this company is competing against, in my opinion. It's not so much about the other companies that are offering the same services like Atlas here, because they're locked into long-term contracts, it's hard for companies to just wiggle out of them and jump to a new customer, right? So, and just to drive this point home, really, what I wanted to show you was this line here, which I don't know how well you can read this, but this is in their most recent 10K, and they give some commentary on this. So they say, demand for air cargo transportation services correlates closely with general economic conditions, which is what we'd expect. I mean, a lot of businesses correlate with economic conditions and the commercial activity in the geographical area. Stronger general economic conditions and growth in a region typically increases the need for air transportation. So they're basically telling us what will drive demand for their services. And then what they say down here is pretty simply when aviation fuel prices increase, shippers will consider using ground transportation if the delivery time allows. But what they would say before that here is time critical delivery needs such as just-in-time inventory management. So just-in-time inventory management is becoming much more popular in the modern economy. This is kind of why you're seeing supply chains become so fragile because goods are needed to be delivered at certain points in order to be most efficient. And you need to manufacture things to meet demand, and demand shifts so much that you have to manufacture things quickly, or what's known as just-in-time inventory management. That if there's one little blip in the supply chain, it can cause ripple effects, which is similar to what we're seeing in the semiconductor space right now with that whole shortage going on. But then they say just-in-time inventory management increase the demand for air cargo delivery, while higher cost of aviation fuel generally reduces the demand for air delivery services. So I found that really insightful because that really explains to you what trends you can look at to understand how it will impact this company's profitability going forward. So that was a good point there. Now, number three is e-commerce. So e-commerce growth is a huge tailwind for this company. So this is from their Q2 earnings call, which happened earlier this week. It's a pretty basic statement, but they're basically saying e-commerce remains their principal driver of growth. Customers still prefer buying online and not just for convenience. They are looking for the lower prices they often find online to stretch their own budgets to cover inflation. We remain direct beneficiaries of the rapid delivery that online shopping requires and will keep reinvesting the majority of their strong cash flow to meet this demand. And then this here is the quote that I had previously. It's talking about just-in-time inventory management. So e-commerce is a huge driver for them. They are an enabler of e-commerce. They're part of the whole logistics network. They transport physical goods. So if e-commerce continues to grow, which pretty much every market forecast you can find is projecting e-commerce to grow in the double digits for years to come, then this company will be a beneficiary of that. But if you combine this with the fact that their cash flow is recurring, it's stable, it's predictable, they know how to plan for these things in advance. And management even said that they're currently experiencing more demand that they can really keep up with. There's excess demand in their industry. And for them, it's really just a matter of building out their fleet of airplanes and then leasing them to their existing customers. It's not even about, growing their business in the sense that some other companies might have to grow their business, which is market products, acquire new customers by marketing, that type of thing. They just really need to build out their fleet and then lease it out to their existing customers. So this ties in really well to my final point, which is probably the most important point about this company. And that is a significant portion of their capital expenditures is growth capital expenditures. So if you don't know the difference, there's two different types of capital expenditures. There's maintenance, also called sustaining capital expenditures, and there is growth capital expenditures. So maintenance is really just capital expenditures designed to make sure that the assets you have stay working at the capacity you need them to. So you're not growing the business, it's more just things like tune-ups of equipment and that type of thing. Whereas growth capital expenditures is actually increasing the earning capacity of the business itself. Now, not all companies are going to break out their sustaining and maintenance capital or maintenance versus growth capital expenditures like they did here, but they did. And this provides us a ton of insight because, for example, if we look at their cash from operations in the last 12 months is about 500 million. And their maintenance capital expenditures, if we deduct that, is 172 million, as we can see here in the last 12 months, which gives 355 million in basically what their peak earnings would be, or if they were optimized for profitability and they decided to stop growing, this is how much money they'd be making. And their current market cap is about 2.3 billion, which means they're only trading at about 6.5 times their optimized earning point, essentially. So to me, that's a key insight, and that shows that the company is reinvesting in their growth. They're deferring profitability today and cash flow today for more cash flow in the future by investing in it. So if you were to do a DCF analysis on the company, which I did try to do, it would spit out as being extremely, extremely overvalued. And that's because they don't have a lot of free cash flow currently, because all the cash they're generating, they're reinvesting back into the business and increasing their fleet, more airplanes, converting those airplanes into freighters, which cost about $30 million to do, and then leasing them to their existing customers like Amazon, DHL, and then their agreements with the Department of Defense. Now, this is pretty similar to a metric that was created by Warren Buffett called owner's earnings. So I've actually got a script here in Tickernomics that I created. So if you wanted to access this, if you go to public scripts here, you should see it right here. It's called Warren Buffett owner's earnings. So then what you do is just click save to my scripts. And then you can go to your scripts and here it is. So then how it works is you enter the company you're looking at in the parameters here. So we'll do ATSG. You basically just enter the ticker symbol here where it says enter ticker symbol, and then you hit run. And then it calculates what owner's earnings is. Now it does have to estimate what maintenance and growth capital expenditures will be because not all companies will report it. This one does, but the website can't pull that specific data because it's not data that it's required to report. It's more just something they would provide investors if they want to give them more information. But what's interesting is you can see the price to owner's earnings ratio. What it's saying is it's 5.5, but it's really more like 6.5 as we discussed. But the price to earnings ratio is 11.6. So there's a huge discrepancy there between price to earnings ratio and price to owner's earnings ratio, which again goes back to my point that they're deferring cash flow today to, increased cash flow in the future, which companies that do that tend to perform well. That's something that Costco was doing 20 years ago. That's something Amazon has been doing for a long time. I'm not saying this company is going to turn out like those, but it's generally a positive quality that companies do. And it's a company that's pretty under the radar, in my opinion. And you can kind of think of growth capital expenditures pretty similar to a company making an acquisition because they're in essence the same thing, right? When a company makes an acquisition, they're spending cash now to purchase an asset that has value and it's going to generate cash in the future, that being another business. But it's pretty much the same thing with growth CAPEX, right? Both of those purchases, whether it's growth CAPEX or buying another business, are increasing the cash generating ability of the company. Now, with a business acquisition, there is the chance that there might be synergies. So the fact that the companies, when they're combined, are more valuable and more profitable than if the companies were to operate separately. So that's another thing you have to consider. But with growth CAPEX, like what they're doing here, is they're spending cash in order to increase the cash generating ability of the business, which is why currently their free cash flow is quite low. But as we can see, the economic reality is that it's actually quite high. They're just spending it on assets. So if you are interested in identifying other companies to see if they have this quality, I definitely recommend checking out the script I created, the one called Warren Buffett Owner's Earnings on Tickernomics. The estimation of maintenance capital expenditures is here. I basically I have a formula in this where it looks at things like past sales trends and the PPE balance relative to those sales trends to get a general estimate of what maintenance capital expenditures will be. Which we can see it was off on this one, so it was $89 million. But as we can see from the actual presentation here, that in reality it's 172 million. So it's not perfect, but it's going to get you a pretty close idea of what to expect. And because not all companies actually break out maintenance and growth capital expenditures, this is a good tool to help you identify that. So yeah, needless to say, this is a company that's definitely on my radar. I like pretty much everything about this company that I've discovered, except for, like I said, how much leverage Amazon has over them. And the last thing you'd want is to buy a company that can get bullied by another company. And even though everything else is going right for them, because of that one factor, it leads to them producing subpar returns. So that's one thing I'm probably going to look into a bit more and try and understand a bit better. But it's also important to consider that Amazon has been a customer for about 6 years now. And if we look at what it's done over the past 6 years, it's still produced a decent return, 13.04% compounded here since Amazon became a customer, or they became a customer really in 2015. So if you look at that period, well, it depends when you look at it. It's higher now, 20% compounded, but you get the idea, right? Amazon has been around for a while and the company has still done well. Their financials have, significantly improved over that time period. You can see revenue, although it did decrease recently, or we can see here revenue on a yearly basis, it's still been going up and been growing decently. So that's one thing to consider. But yeah, that's pretty much it for this video, guys. I hope you did find this insightful. I do want to make more videos like this where I show you guys what I'm personally researching rather than just a company that I think other people would want to see, just to kind of take you through what I'm personally looking at. So let me know if you want to see more videos like that in the future, and I'll see you guys in the next video.